welcome to the Deep Dive. When we talk about M&A in banking mergers and acquisitions, it often sounds like this really high-stakes boardroom ballet, doesn't it?
Yeah, all about balance sheets, market share, big corporate moves.
Exactly. But what our sources are showing and what we're really digging into today is how it's increasingly becoming this, well, almost a brutal digital battlefield where even the smallest misstep can cost potentially millions of customers almost overnight. These massive moves, they directly impact you, the customer, and your everyday banking.
Precisely. Just think about your banking app, right? How quickly you can make a transfer, check your balance, access things online. All of that stuff is right on the front lines when banks decide to merge.
And that's exactly what this deep dive is all about today. We're going to unpack how M&A profoundly affects that digital customer experience in banking.
Yeah.
Our mission, as always, is to pull out the most important nuggets of knowledge, the key insights from our sources, basically giving you a shortcut to being really well informed on this. It's a crucial topic.
Yeah. Oh, absolutely. And the stakes couldn't be higher, really.
Yeah.
In today's world, everything's digital first, right?
Right.
So a bank's success, frankly, it just hinges on its digital experience. Our sources flag this pretty alarming statistic. A whopping 55% of users, they're ready to switch banks just for a better digital experience.
Wow, 55%. That's huge.
It is. It's not just a number. It fundamentally shifts the power dynamic. I mean, it means customers are now using digital experience almost as a weapon in their loyalty decisions. That's something traditional banking, rarely had to deal with.
That's a massive shift. Yeah. And we saw this play out so dramatically just last year. Remember March 2023?
Oh, yeah. Big news month.
Huge news. First, the Silicon Valley Bank acquisition by First Citizens Bank. Was it $70 billion in assets involved?
Right, and about $56 billion in deposits, yeah.
And then, almost immediately after, UBS steps in to acquire its troubled rival, Credit Suisse, for $3.25 billion.
Indeed. And while both moves were, arguably critical for financial stability at the time, our sources make it really clear. These events also show just how challenging it can be to keep customer trust and, crucially, ensure seamless digital operations during these massive changes.
So the real test, then, isn't just the deal itself.
No. The real measure of success for these mergers really comes down to how smoothly they integrate everything to serve you, the customer.
So those big events really underline how the whole idea of scale in banking has fundamentally shifted, haven't they? It's not just about merging physical assets or, counting branches anymore.
No, it's definitely not. Today, real efficiency, smart scale, it comes from optimizing digital processes.
How so?
Well, when it's done right, bankers can actually spend more time on those high-value customer interactions, giving personalized advice, maybe helping with complex financial planning.
Instead of just admin tasks.
Exactly, instead of being buried in paperwork. But, and this is the big but, if that digital integration is mishandled during an M&A, it can seriously damage the customer experience. It can drive clients straight to competitors.
Yeah, that makes total sense. My own expectations from my bank are so different now than they were, say, 5-10 years ago.
Right.
I want slick digital tools that solve my specific problems, not just a confusing pile of features.
Yeah.
And that personalization piece you mentioned, that feels huge. Do the sources talk about how important that is?
They absolutely do. Our sources show that 59%, nearly 6 out of 10 consumers, expect companies to use all that data they collect to give them genuinely personalized experiences.
Okay.
But there's a danger here. The Interaction Design Foundation points this out sometimes. Merged banks try to integrate these really broad offerings, trying to be everything to everyone.
And that just leads to a bloated app, right? A messy digital experience with no clear strategy behind it. Nobody wants to use an app that's trying to do too much and ends up doing none of it well.
Exactly. And that kind of complexity, especially with poor user experience, poor UX, well, it can just destroy trust. It tarnishes the brand, hurts the business overall.
So M&A in this digital age, it's not just about getting bigger market share.
No, it's a really pivotal opportunity for digital transformation. But it comes with these significant UX challenges. Everything from making sure customer transitions are smooth to unifying different tech platforms and, crucially, maintaining that trust.
Okay, so our sources break this down into 4 key scenarios, which I found really helpful for understanding the different flavors of these challenges.
Yeah.
Let's dive into the first one, the creation of a new brand. What's the main hurdle here?
Right. So this is when 2 or more banks merge and decide to create an entirely new entity. New name, new logo, the works. A good example was back in 2017, DNB and Nordea merged their Baltic operations to create Luminor Bank.
Serving over 1 million customers, right?
Yeah, exactly. So the trickiest part, you're basically asking two completely separate groups of customers who are used to different apps, different websites, different ways of communicating.
To suddenly adapt to something totally new.
Precisely. It's a massive leap of faith you're asking customers to take.
I can immediately see the challenges. You've got customer trust, right?
Yeah.
And familiarity. Then there's the disruption to the user experience itself. Potential communication gaps if they don't nail the messaging.
Confusion, skepticism.
And then just the basic digital adoption curve. People need help figuring out the new tools. So how do the sources say banks should tackle this strategically from that digital experience angle?
Well, it really has to start with a stability-focused IT migration. That means aiming for a seamless technical transition, doing phased rollouts, lots of testing.
To get the tech right first.
Yes, but the really critical piece is the strategic alignment. Mapping every single digital touch point, the app, the website, email communications, to the new brand's vision.
So it feels cohesive.
Exactly. And they need to actively look for friction points, but also the wow points through UX research, essentially blending the best bits from both the old banks.
Makes sense.
Then clear communication is just paramount. You have to ensure people understand the migration, what's changing, why it's better. And finally, empowering adoption, think interactive guides, maybe webinars, definitely in-app tutorials. The goal is always to make the new feel familiar, but also clearly better.
Right, make it an upgrade, not just a change.
Yeah.
Okay, so if that's the ideal for a totally new brand, what happens when a bank tries to sort of live in two worlds at once? That brings us to scenario 2. One bank, two brands.
Yes. A prime example here is the 2018 merger of Deutsche Postbank AG with Deutsche Bank in Germany.
Okay.
The idea was Deutsche Bank would focus on advisory services, wealth management, that sort of thing, while Postbank would handle the day-to-day retail banking. Keep them distinct, serve different market segments.
But I feel like I've heard some less than positive stories about that one. What went wrong, according to the sources?
You're right to feel that way. This case really highlights the significant risks of IT integration, or maybe the lack thereof. Postbank, for instance, had these massive problems with customers being locked out of their accounts.
Oh, wow.
Which led to a huge surge in calls, overwhelming their support centers. By 2023, Postbank ended up being the lowest-ranked German bank on Trustpilot. Their rating was dismal, like 1.2 out of 5.
Ouch. So what was the core issue there?
The core issue really was attempting to run two distinct brands on technically separate, often quite old legacy systems without a properly unified back-end infrastructure.
Wow.
This just created inconsistent brand experiences. Customers were confused, which bank do I use for what? The brand identity started overlapping awkwardly. And eventually you just had support overload from really frustrated clients.
Yeah, that's a textbook example of digital failure impacting customers directly. So strategically, from a digital experience view, what are the fixes? What should they have done?
Well, banks in this situation need to really assess the digital experience for both brands, make sure each one actually aligns with its distinct strategy.
Right.
They've got to define a clear improvement plan based on understanding what clients expect and what's frustrating them. And then, crucially, map out a comprehensive digital ecosystem, one that optimizes for each brand's unique identity, but, and this is key, ensures technical stability underneath.
And what about managing that customer interaction day to day to avoid that confusion?
Onboarding optimization is vital. You need continuous user research to make sure clients are satisfied and understand things. And critically, you need to unify the systems where it makes sense.
How so? Like merge everything?
Not necessarily the front ends. You can maintain distinct apps or websites, but unify the core functionalities and, very importantly, the design systems.
Design system?
Yeah. Think of it as a shared library of digital building blocks, colors, fonts, button styles, interaction patterns. It ensures that even if the brands look slightly different, they feel connected and work consistently. Plus, implementing cross-brand customer service is critical to prevent the kind of meltdown Postbank saw.
Got it. Okay, on to scenario 3. One brand takes over, another one. This feels like maybe the most straightforward scenario on the surface. The acquiring bank just absorbs the other one, phases out its brand.
Yeah, visually it seems simpler. The most recent high-profile example is UBS Switzerland AG completing its merger with Credit Suisse Schweiz AG, legally finished in 2024.
Right.
Now, while Credit Suisse clients will initially keep using their existing platforms, the plan is for most client transactions to migrate over to UBS's systems starting late 2024 and into 2025.
So eventually those former Credit Suisse customers will be fully folded into the UBS world. I can definitely see how that could lead to some, well, customer loyalty erosion. People might feel forced into this new relationship. There's a real potential for an emotional disconnect there.
Precisely. That's a major challenge. Others include the very practical headaches of data and platform migration. Customers might have to switch apps, maybe learn new online banking interfaces, perhaps lose loyalty program points or history.
Which means you need specific onboarding for those customers.
Exactly, and continuous customer education as they adapt to these unfamiliar tools. The big fear for the acquiring bank, like UBS, is losing those loyal Credit Suisse customers entirely during the transition.
So what are the strategic tasks then to make that transition as smooth as possible and hopefully minimize that customer loss?
Now, number one, a transparent migration roadmap. You have to clearly spell out what's changing, what's staying the same, when it's happening, and crucially, what the benefits are for the customer.
Communication is key.
Always. Then, structured onboarding needs to be designed carefully with really clear guidance. Banks should also seriously consider offering exclusive welcome benefits or perks to make these incoming customers feel valued, not just absorbed.
Make them feel wanted.
Yes. And customer-centric data migration is a must. Ideally, single login transitions where their data is auto-migrated as much as possible. Minimize the hassle. And finally, clear, consistent support. Leverage the acquiring brand's reputation with reliable service and messaging.
That makes sense.
Yeah.
Okay, that brings us to our fourth and final typical UX challenge scenario. Fintech-powered expansion. This is when a traditional bank buys a nimble fintech company to boost its own digital offerings.
Right. A great example here is U.S. Bancorp acquiring Travel Bank back in 2021. Travel Bank is a fintech focused on expense and travel management for businesses.
Okay.
This acquisition led to U.S. Bank launching a new commercial card product in 2023. And notably, they actually had a prior partnership integrating U.S. Bank's instant card feature right into Travel Bank's app even before the acquisition.
Interesting. Now, this one sounds like it could be a real culture clash waiting to happen.
Definitely.
You've got the agility, the speed, the move fast and break things mindset of a fintech, meeting the structure, the regulation, the slower pace of a traditional bank. How does that usually play out for the customer?
It often manifests as an approach clash, absolutely. For the customer, you might experience tech integration complexity. Think modern cloud-native systems, which are usually faster, more responsive, giving you that snappier app experience.
Right.
Running up against older, perhaps slower, legacy banking systems. This immediately creates customer expectation gaps. Fintech users are used to speed and slick interfaces. Bank clients often prioritize stability and maybe are used to a more formal experience.
And the look and feel could be totally different, too.
Exactly. Brand and UX mismatch is common. Different risk tolerances between the two cultures can stall innovation. And then there are significant talent and culture gaps. Maybe the fintech skills aren't used properly, or maybe the fintech employees just can't cope with the bank's hierarchy and processes.
So how do they bridge that gap strategically? How do they make it seamless and beneficial for the end user, for you?
Well, it really requires dedicated innovation design, using user research to implement new capabilities that genuinely solve customer problems, not just because the tech is cool.
Needs-driven, not tech-driven.
Precisely. Then, integrating the digital journeys. That means carefully evaluating the user flows across both the bank and the fintech to find those points of synergy where things can be combined smoothly.
Okay.
Establishing a unified design framework is vital here, too. A shared design system, again, but one that respects both the fintech's agility and the bank's established standards and need for trust.
Finding a balance.
Exactly. Implementing what you might call agile compliance, embedding regulatory checks into the fast-paced product development cycle, not just tacking them on at the end.
Yeah.
And finally, empowering support. Simplify the digital experience for speed, but bolster user confidence with transparent policies and really robust assistance when they need it.
That's a really comprehensive look at the challenges across those four scenarios. But thankfully, our sources don't just leave us with the problems. They also offer a pretty powerful roadmap for how M&A can actually become a catalyst for positive digital transformation.
So what are these strategic pillars they outline?
Yeah, the overarching principle that comes through is that M&A should be seen as this golden opportunity to modernize technology and really reimagine customer value. It shouldn't just be a cost-cutting exercise that ends up creating chaos for customers.
Makes sense.
So our sources lay out 7 key strategic pillars for getting it right.
Okay, what's the first one? Pillar 1, define a target audience and commit to it. This sounds basic, but it's crucial. It means focusing resources, money, time, talent on curating tailored digital solutions for specific customer segments.
Not trying to be everything to everyone.
Exactly. A Forrester report from 2024 showed that brands laser-focused on customer needs achieve 41% faster revenue growth and 51% better customer retention. It's about delivering the right solutions to the right customers, preventing that bloated app syndrome we talked about.
Right. Quality over quantity with focused intent. Okay, pillar 2. Modernize the tech stack early. Why early?
Because it's a critical window of opportunity. Addressing those clunky old legacy systems early in the M&A process can prevent technical debt from just piling up and becoming an even bigger problem later.
Okay.
We're talking about consolidating platforms where it makes sense, really leveraging cloud-based solutions, maybe bringing in AI capabilities. McKinsey research from 2022 found that 74% of CEOs see technology integration in M&A as a key driver of competitive advantage and growth.
So it's not just fixing problems, it's actively building an advantage.
Yes, it's about building a digital foundation that future-proofs the bank and directly impacts the speed, reliability, and features of your online banking experience.
Got it. Not just a cost, but a driver of advantage. I like that framing. Okay, pillar 3, champion a culture of data literacy. How does, teaching employees about data translate into a better digital experience for us, the customers?
Well, data is just fundamental to digital transformation, isn't it? Employees, everyone from the frontline staff answering calls to the top leadership, need to see data as integral to their daily work.
So it's not just for the analysts?
No. It means providing training, embedding data-driven decision-making into processes, using AI insights, for instance, to refine those self-service portals you use online. When employees truly understand and use data effectively, they can start to anticipate your needs, personalize solutions better, and just make your interactions with the bank smoother, faster, and more relevant.
Okay. Pillar 4, streamline internal workflows. So It's not just about the shiny customer-facing app then?
No, absolutely not. What happens behind the scenes matters immensely. This pillar is about applying user-centered design principles to the tools bank employees use themselves.
Internal UX.
Exactly. Automating tedious administrative tasks, resolving those friction points in the back office. Imagine, for example, loan officers spending less time wrestling with clunky software and more time actually talking to customers, giving personalized advice on mortgages or loans.
That directly benefits the customer in the end.
Hugely. It boosts loyalty, improves service speed, and frees up staff to provide real human value.
Which leads nicely into pillar 5, communicate a unified brand vision.
Yes. When you're merging brands or even just absorbing one, consistency in the digital brand identity is just crucial for building trust. This means a unified design language, using those design systems we mentioned, maintaining a consistent tone of voice across all channels, the mobile app, the website, emails, even social media. It all works together to build a sense of trust and stability. Remember that EPAM research from 2020? 63% of people said trust was the main reason they chose their primary bank.
Wow.
A fragmented, inconsistent digital presence just erodes that trust immediately.
Trust really is the currency of banking. Okay, pillar 6, balance compliance and innovation. This sounds like walking a tightrope.
It absolutely is, and it's especially relevant in those fintech acquisition scenarios we discussed.
Right.
This means putting together multidisciplinary teams, people who understand the creative side, the tech side, and the regulatory dimension. They need to work together to streamline product integration, get new features out quickly, but without compromising on risk management or the core customer experience.
So innovating safely.
Exactly. It's about accelerating innovation, bringing you useful new features faster, while always maintaining that rock-solid security and regulatory adherence you absolutely expect from your bank.
Makes sense. And finally, pillar 7, focus on employee integration and engagement. Why is this so critical?
Because mergers inevitably bring different company cultures together. That can cause friction, uncertainty, even resentment among employees. And guess what? That directly impacts customer service.
Unhappy employees, unhappy customers.
Pretty much.
Yeah.
McKinsey's 2024 report highlighted this. Companies that effectively manage the cultural integration during M&A are 50% more likely to meet or even exceed their synergy targets.
Synergy targets being?
Oh, sorry. That's a combined benefits and efficiencies they hope to achieve by merging in the first place. So investing in change management programs, encouraging open communication, providing training at all helps employees adapt, feel valued, and ultimately deliver those seamless customer experiences. If the employees aren't integrated properly, your customer experience won't be either.
That's a really crucial point. It's clear that these M&As are incredibly complex. They're long-term processes, often spanning years, not months. So, with all this digital complexity, what role does having a strategic UX partner play? Is it necessary?
Our sources really emphasize that, yeah, having that kind of partner can be crucial, especially for navigating this digital minefield smoothly. They help with proper resource allocation, they help prevent user loss during tricky transitions, and they can stop internal teams from becoming misaligned on the digital goals.
So they bring outside expertise.
Exactly. Expert support that can adapt as goals inevitably shift during a long M&A process. They can analyze the different digital platforms objectively, ensure a seamless user experience is maintained or improved, and fundamentally keep the end user, keep you at the very heart of every decision. It's about having dedicated expertise focused solely on navigating that complex digital landscape, making sure the bank prioritizes what truly matters to customers.
This has been such an insightful deep dive. It's easy to forget sometimes that behind every slick new banking app update, there are countless hours of human integration work, cultural alignment, strategic decisions. It's not just lines of code.
Indeed. And I think to sort of recap the core idea here, sustainable growth in banking M&A today, it isn't just about the size of the balance sheet anymore. It's fundamentally about the bank's ability to deliver superior customer-centered digital experiences.
Right.
And that means strategically integrating the technology, yes, but also harmonizing the cultures and consistently, relentlessly prioritizing that customer experience.
And presumably getting that right, having that strategic advantage of a truly customer-centric digital experience makes a bank more attractive for future opportunities too, whether it's more acquisitions or just organic growth. And this leads us perfectly, I think, into our final thought for you, our listeners, to consider. In a world where digital convenience is absolutely paramount, where that 55% are ready to switch, what does the future really hold for those financial institutions that fail to make the customer's digital experience the absolute central focus of their growth strategy?
Yeah, and maybe more personally, how will that impact the way you interact with your bank or choose your next bank in the years to come?
Something definitely worth pondering as this digital transformation of finance continues to accelerate.
With your expectations as the customer right at the forefront.
Thanks so much for diving deep with us today. We'll catch you next time on The Deep Dive.